When it comes to investing, the two most common types of investors are growth investors and dividend investors, regardless of the route that you choose. And for me, I choose a more balanced approach, having both growth and dividends, because the ultimate focus for me is going to be total return. However, in today's video, we're going to be focusing on 4 huge ETFs with huge yields. So if you're searching for income for at least a piece of your portfolio, you're going to want to stay tuned throughout the entirety of today's video. Before we dive into all 4 of these ETFs, do me a huge favor. Show your appreciation for these videos that we put out on a weekly basis by simply clicking that like button down below. Subscribe to the channel and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, you can check out their 10 best stocks to buy right now by going to fool.com/Mark. All right, let's jump back into our video talking about 4 ETFs with huge yields. And throughout the video, we're going to start with the lowest paying yield. And as we get throughout, you're really going to stay around for that 4th ETF because that's going to be the biggest yield on our list today. So let's begin with high yield ETF number 1, which is going to be the JP Morgan Premium Income ETF, also known as JEPI. This is really the ETF that started all of this high income craze back in 2020. Some of you may be asking, how do these ETFs pay such high yields? And we're going to get to those yields here in a second. But the quick answer is the fact that they utilize options. I often like to say, and it can be done conservatively, but option investing is what takes investors to the next level. And speaking of options, this next Thursday on January 30th, I'm going to be hosting an options trading workshop. Whether you're brand new to options trading, never done it before, or you've been doing it for a few years, this workshop is going to be for you. Plus, you get lifetime access to the recording. Check out the link down in the description below. All right, let's get back to JEPI, where they currently have assets under management of $38.5 billion, making it the largest of the 4 ETFs that we're looking at here today. They currently have an expense ratio of 0.35%, and over the past 12 months, the stock has risen 6%. When it comes to JEPI and how it's run, the fund managers own S&P 500 large cap companies, not the entire index, but many of the large cap, mega cap ones. As you can see here on your screen, the ETF has 129 total positions, with the top positions being Amazon, Meta, and Nvidia. In addition to owning these underlying securities, the fund managers also, as I mentioned, utilize options. And what they do is they sell what's called out of the money call options. This allows them to earn a premium. And what index do they track? The S&P 500. However, when it comes to covered call ETFs, although you're able to generate more income, what you're also doing though is capping your upside potential. Anytime the S&P 500, in the case of JEPI, goes above and beyond the strike price that the fund managers selected for that week or that particular month, JEPI does not participate in any of the gains above that particular strike price, meaning that the upside is capped. So as you can imagine, with that being said, the profits or the distribution is going to be volatile based on how profitable the trades are or not profitable the trades are. As you can see from this chart, the yield has been below 5% to as high as 12% in early 2023. But with the S&P 500 performing quite strong the past 2 years, trades have been less profitable, hence the decline in yield, which currently sits at 7.1% and is paid out on a monthly basis. Again, this is the lowest yield on today's list. And that leads us to high yield ETF number 2, which is going to be the JP Morgan NASDAQ Equity Premium ETF, also known as JEPQ. JP Morgan had a very successful launch with the likes of JEPI, one of the most popular high income ETFs on the market today, that they had to launch a sister fund, which is JEPQ. Instead of following the S&P 500 like JEPI, this one kind of follows along the same lines and strategy, but instead of selling calls on the S&P 500, it follows the NASDAQ 100. JEPQ has assets under management of $22.4 billion, and it has that same exact expense ratio of 0.35%. And over the past 12 months, JEPQ is up 12%. So again, the setup is quite similar in the fact that they sell out of the money call options, but focusing more on the NASDAQ 100. So that upside is capped. This is something that we are going to cover on Thursday's workshop, January 30th. I'll be hosting that workshop. And again, you can sign up using the link down in the description below. JEPQ has a total of 105 holdings, with the top holdings being NVIDIA, Apple, Microsoft, Amazon, and Alphabet. So in addition to owning these underlying securities, they are taking the combination of the dividends paid by them if they pay a dividend, and then juicing that with those out of the money call options on the NASDAQ 100. And just like JEPQ pays out their distribution on a monthly basis. As you can see from this chart, the yield has been, again, below 5% to more than 12% in early 2023. But given the strong move in the NASDAQ, as like we saw with the S&P 500, yields have fallen to below 10%, but still produces a solid 9.4% yield. Similar in many ways to JEPI, but instead focusing more on the NASDAQ 100. And that leads us to high yield ETF number 3, which is going to be the Goldman Sachs NASDAQ 100 Premium Income ETF, also known as JPIQ. Seeing the popularity in both JEPI and JEPQ, Goldman Sachs also wanted to get in on the fun. So we're going to move away from JP Morgan, but again, the strategies are very similar to what we just saw with JEPQ, because this Goldman Sachs Income ETF is again focusing on the NASDAQ 100. JPIQ has assets under management of $400 million, an expense ratio of 0.29%, which is the lowest ratio on our list today, and over the past 12 months, it is up 11%. If you recall, the strategy that we talked about for both JEPI and JEPQ was to sell what's called out of the money call options, meaning the strike price that the fund managers selected was higher than the fund's actual price today, or the index price. When it comes to this Goldman Sachs Income ETF, how it differs itself is the fact that it sells at the money call options, meaning it is pretty much right in line with where the NASDAQ 100 index is trading at today. What does that allow you to do? It allows you to generate more income, but it also doesn't allow for much upside overall. So for example, with JEPQ, if today's index price is selling at $50 and we sell the $55 call option, we can take part in the gains from 50 to 55, but nothing above that. However, when it comes to this Goldman Sachs Income ETF, they're going to sell closer to the $50 level, meaning if the index does in fact go up to 55, we're not really taking part in any of those capital gains. GPIQ has a portfolio of 112 holdings, with the top holdings being NVIDIA, Apple, Microsoft, Amazon, and Broadcom, nearly identical to the top positions we saw for JEPQ. Based on selling those at the money call option, it has allowed the fund to yield a distribution of nearly 10%. And like the others we've looked at, the distribution will fluctuate and it is paid out on a monthly basis. And do not forget about the lower expense fee as well. And that leads us to high yield ETF number 4, which is going to be the Granite Shares Yield Boost Tesla ETF, stock ticker TSYY. Now this ETF here, although it is still an income ETF, is going to be very different than the first 3 ETFs that we looked at. All 3 of the first ones that we've looked at have been based on an index. This is more based on a single stock, and a leveraged single stock at that. And you could probably guess which stock that is, which is Tesla, stock ticker TSLA. And unlike the first 3 ETFs, which sold call options, TSYY is going to be selling put options. But they're not selling put options on Tesla stock. They are selling put options on a 2x leveraged ETF, which tracks only Tesla. So think about it this way. In the leveraged ETFs that track Tesla, when Tesla goes up 4%, the 2x leveraged ETF goes up 4%. It doubles it. When Tesla is down 5%, the leveraged ETF is down 10%. So what TSYY is doing is it is selling put options on that leveraged ETF. So as you can imagine here, this ETF is going to produce huge income. but it's also going to be quite volatile. So make sure you do know the risks and do your research before investing in really any of these ETFs we're talking about today. If you have followed me for any amount of time, then you may have seen me have the opportunity to ring the bell at the NASDAQ in December of 2024, which was when TSYY came about. So this is a very new ETF, but not a new concept for Granite shares. The ETF currently has assets under management of 1.6 million, by far the smallest on the list, but again, it is brand new. The expense ratio sits at 1.07%, by far the highest, and its 1 month performance is plus 1%. However, to give you an idea on the income potential here, here's a look at all 4 high income ETFs over the past month alone, based on total return. TSYY far exceeding the others with 6.3%, with all of the others having returned less than 2%. Given that the ETF is selling put options, and options alone already adds to the risk level, and adding on top of that, it is selling put options on a leveraged ETF, that tracks a highly volatile stock, you really have to understand the volatility that can come with this, as well as the risks attached. It can bring huge income, though, at the same time. In addition to selling these puts, the ETF and the fund managers also invest in U.S. Treasuries to help fund the huge monthly distribution. Now again, they've only been around for a month and paid one single distribution, so there is no distribution yield at this very moment, but this is something that is going to be huge and something to keep on your watch list. This ETF doesn't have much upside. You're not investing in this particular ETF for capital appreciation. You're focused here on income. And this is going to be, when you see an annualized distribution yield, this is something that's going to be well above 20%. So there we have it, 4 high yield ETFs. One very different than the other 3. But when you have JEPI, which really started all of this craze, then you launched into the sister fund with JEPQ, then Goldman Sachs wanted to get into the fund, and now we have Granite shares with a single stock leveraged ETF focus by utilizing options for higher income. Down in the comments section below, let me know which of these ETFs, if any of them, would you be interested in investing in. And for me, when it comes to these leveraged or these income ETFs, I utilize them on a short-term basis. I don't look at any of them for long-term positions within my portfolio, but when I accumulate a lot of cash, I will pick and choose a few of these ETFs to invest in to produce some higher yields. So let me know there down in the comment section. If you haven't done so, make sure you hit that like button, show your appreciation, subscribe to the channel, and we'll see you in the next one. Take care.